unpredictable risk. Because you mentioned a few minutes ago, the companies, they the insurance companies like to price stuff that they know what the frequency and severity is, or they'll continue to add more and more exclusions and narrow the coverage. But a lot of times we get called in on people who have new, that could be completely new technology. And the traditional market isn't really good or doesn't really want to start pricing, the novel ideas or novel technologies. Think of Elon Musk's Neuralink, and then going out to the traditional market to say, well, we're going to put, adapters in people's brains to then feed and take information from it. And you go to Chubb, their head's going to explode. But people come to us, you and I, because they have that type of risk. So what's kind of the philosophy on pricing, and where do you even start with that?
Well, we start the same way insurance companies start when they're going into a new market. So you start with putting parameters around it, like estimating frequency, estimating severity, but then knowing that we don't have a very good estimate of frequency and severity. So we need to keep checking in with it. We also start with setting a policy limit that if we're wrong, then it's okay. Sometimes we have to set too high of a premium, and then the captive doesn't want to write the policy, and that's okay. But the size of the premium indicates how much uncertainty we think there is in the risk. And it's a learning thing over time. The more experts you can get involved in the question at the beginning of the process, the better the estimate will be. But experts can be wrong. And so it comes down to using the best information available at the time and learning as you go.
So I guess it's one of those chicken and egg scenarios. If you're pricing an unknown risk, do you start with the policy and what's going to be covered, or do you start with your frequency, your work, and then from there tell the attorneys how to draft it? Which one is what is the preferred way to go about it?
It depends on the scenario, and it might be all hands on deck to get to try and wrap our hands around what could happen. And so that's a hard question to answer. The cyber risk, as it's emerged over the last couple decades, is still largely unknown. We pulled together all the best databases we could and tried to estimate reasonable frequency and severity, and found it maddeningly difficult to estimate. I asked a cyber expert in the field what we should worry about, and he said, I don't know, do you have another country's government that doesn't like your company? That might be the single reason you get hacked. And so the exposures involved are just hard to measure. And so when the exposures are hard to measure, you can't with certainty set a reasonable price. What you can do is set up policy limits that you can be sure to cover given the diversification of the risk. You can set up coverage provisions that only cover the parts you're most comfortable with at this point. So we end up having to do the same thing the insurance companies do, but we customize it to the individual captive.